Welcome to this training, the perfect storm for a thoughtful seller financing. In this presentation, in this training, I want to tell you why I really believe that the upcoming chapter and market cycle that is happening right now and that's ahead of us creates the absolute perfect conditions for us to make a lot of progress in our real estate investing endeavors, our wealth building endeavors through the acquisition of rental real estate with seller financing. I'm so excited for this. So let's dive right in. And I want to start by just kind of breaking this statement down, our headline for this training. We have the perfect storm. Well, what does that mean? I would say it means that there is an alignment of multiple favorable conditions for acquiring properties this way. And seller financing. Well, what do we mean when we say seller financing? Seller financing, we will give a broad definition to here. That means that we are able to fund our acquisitions of rental properties without going to banks and getting loans. But wait, wasn't there another word in this headline? Yes, there was. There was one more important word, in fact, and that is thoughtful. What does thoughtful mean? Thoughtful means that we have done our acquisition in a way where we've negotiated it sensitively and we have negotiated strategically. And I really believe it's the intersection of these three things, right? The perfect storm, seller financing, and thoughtfulness that creates incredible opportunity for us. So let's start by talking about why it is the perfect storm for seller financing right now. In order to understand the chapter ahead of us, we really should look backward at the chapter that we've just come out of. And when I say chapter, I mean a market cycle, the last several years and the overall dynamics in that market during that period of time. So if we look backwards at this last chapter, what was it like? Well, it had a few defining characteristics. It really felt like a seller's market. If you were to look at the official properties listed on multiple listing service sites, it looked like there was very low inventory. It also felt like prices were rising pretty quickly. And all of this meant, as a buyer, it didn't feel like buyers had a lot of leverage in the negotiations because there was simply a supply and demand dynamic where there was much more demand than there was supply. And that kind of left buyers feeling a little bit powerless. But there was also one other aspect besides just the real estate market itself. There was the financing market. And in this past chapter, we had affordable loan interest rates. We had reasonable loan programs such that as long as a person qualified, they should be able to get a loan and at historically low rates. So how did all of this make buyers perceive seller financing in this previous chapter? Well, I spent a lot of time talking with investors who were trying to buy during this period of time and talking to them about seller financing. And what I found pretty categorically was that most buyers felt like seller financing was super uncommon. They felt like it was really difficult to find it, like finding a needle in a haystack, and very difficult to negotiate. And they would say and sort of imply things like this, sellers can command cash offers. Why would they ever sell via seller financing when they can command cash offers? And the overall kind of perspective and assumption was kind of like this. People would say, look, seller financing is what sellers do when they can't sell their property in any other way. It's kind of a last resort. And so even then, they do it reluctantly. So let's just back up for a quick second. I want to revisit the question that I just asked you. How did most buyers perceive seller financing in this previous chapter? Let's focus on this word perceive. They perceived it to be as I just described, which was very difficult to get to. That's how they perceived it. But was that perception actually true of this last period? And I would say no, it wasn't really true during that period at all. Seller financing absolutely was happening during that chapter, during that market cycle, but it was happening for different reasons than most investors realized, or most investors were able to understand at that time. See, there's always motivations for seller financing. In this last chapter, a lot of seller financing was done by sellers who were motivated to defer their capital gains tax obligation without doing a 1031 exchange. So let's just stop and pause and break that down for a quick second. An investor who has owned a piece of property for a long time, even a few years in a rising market, would have a capital gains tax bill if they were to sell the property. And in fact, the fact that the market was up meant that their sales price would be even higher, and that would make their capital gains tax bill even higher. Well, most investors know that they can do a 1031 exchange to defer their capital gains tax into the future, but not everybody wants to. There are sellers who are at a certain point in their life when they just don't really want to simply trade one responsibility for another. And even if they did want to trade one responsibility for another, in this market where it was a great time to be selling a property, it was also a difficult time to be buying a property. And in a 1031 exchange, you have to do both. So there were definitely sellers who wanted to defer capital gains tax without needing to do a 1031 exchange. And that was a big driver for a lot of seller financing sales. The installment sale structure of seller financing can be used and designed in a way such that it helps a great deal to soften the pain of a capital gains tax bill and spread it out over time, or even delay it. Secondly, sellers during this period were really motivated to continue getting an income stream from their property without needing to find a new investment. So during this time, if a seller owned a rental property, they probably owned that rental property because they liked getting income. If they were to sell that property, then their income stream vanishes. So let's say they get cashed out and they've got $300,000 that they just got from the sale of a property. Now they're looking at $300,000 sitting in a checking or savings account saying, well, shoot, it's not really that useful sitting in a checking or savings account. I need to find something to do with this to create income again and to put this money to work. So now they're back out there looking at other investment options in a low interest rate environment, and they might not be that excited about the prospect of having that project in front of them. It felt like a responsibility or a burden to many people to go find a new investment. So in this past chapter of seller financing that was happening a lot, these were the things that were making it happen for those sellers. So in other words, sellers were selling in this previous market cycle with seller financing because it was the best path for their own financial interests. So I really think that first, before we continue further with this discussion of what makes seller financing so great now, we must recognize and appreciate the fact that even the previous chapter was actually a really good time to be buying properties with seller financing. It's just that most investors weren't tuned in to understanding exactly what those dynamics were, and thus they didn't know how to find and negotiate those types of deals. So how is this next chapter looking forward? How is this chapter ahead, the one that we're starting right now, different? Well, in this next chapter, we have what is certainly a more balanced market. The demand has not necessarily lessened, but the supply has increased quite a bit. And it's starting to feel more like a balanced market. By comparison to the previous chapter, at this moment, it feels a lot like a buyer's market instead of a seller's market. But in reality, at least as of the time of this recording, it's just simply becoming a more balanced market. But coming out of a period that felt like a heavy seller's market, it feels very drastically different. Inventory on the multiple listing service is much higher. There's more properties that are publicly for sale. Prices are no longer increasing in most cases. They are stabilizing, leveling off, or maybe even in some cases, lowering, right? You see price cuts on certain properties that are listed for sale and things like that. And from the buyer's perspective, it feels like there's certainly now more room for negotiation. But just as the previous chapter was marked by not just real estate supply levels and demand levels, it was also marked by the lending environment. Well, that's the same case here. So these things are true for this chapter we're entering right now, but also this chapter is being marked by much higher interest rates. Loans are much more expensive to get, and that means that buyers have reduced buying power. For instance, if you could afford previously, let's say a homeowner could afford a $2,500 per month mortgage payment. Well, a $2,500 per month mortgage payment, let's say, used to buy them a $500,000 property, but now with higher interest rates, the $2,500 mortgage payment might buy them a $350,000 house. So that's putting pressure on pricing because the buying power of these buyers is reduced by the higher interest rates. So the effect overall is that these things kind of cause this next chapter, this next market cycle, to look a lot more stagnant maybe than the previous one was, where things were moving very, very quickly. So what exactly is it that we have on our hands? Well, what we have is a group of sellers who may have finding themselves to have a hard time selling their properties. It might just simply take them longer. They might have to lower their prices. They might have to be more flexible or give concessions of some sort. And you have sellers who feel like they've missed the window of opportunity. They're frustrated. They felt like they had all the control, and now suddenly the market is very quickly shifted, and now they feel like they've missed this window of opportunity. We have sellers who are negatively impacted by their buyers' inability to get favorable loans. It's not really that people don't want to buy the sellers' homes anymore. It's that the buyers can't get loans that are really worth getting. If they can get loans, they're very expensive, and so sellers are the ones kind of who suffer as a result of buyers' inability to get favorable loans. So what does all of this actually mean? Let's put it all in the blender and kind of see what comes out. What it really means is that we have a whole new set of motivations for sellers to sell with seller financing. Today, in this current and future near-term chapter, this next market cycle, the motivators for a seller to sell their property with seller financing might be to sell their property faster, right? Instead of maybe it taking 90 days, maybe they can move the property and sell it in 40 days instead of 90. They can sell at a higher price, or perhaps just not have to reduce the price quite as much, right? So if they list their property for $400,000, and maybe while other sellers are lowering prices to $350,000, maybe they can hold closer to $400,000 if they offer seller financing. And overall, really what it's helping them do is be more competitive with the other properties that are for sale, who they are competing with, right? That's the reality, is when you put a product out to market, you are competing with the other products that those buyers could buy. That's the same truth whether you're selling coffee or tires or real estate. These sellers are now competing with other properties for sale, and this makes them more competitive. So in other words, offering seller financing can help them sell their properties more easily overall. Why does it help it be easier for them to sell their properties? Because if they provide seller financing, then they're removing the single biggest obstacle that their potential buyers have, which is the ability to get decent financing that makes the transaction happen. But wait, there is something else. In fact, there's another big factor that we have to acknowledge about today's market cycle as well. Many of the sellers in today's market are selling properties that are financed with really good, low-interest, long-term loans. Why? Because they got those loans during this last chapter, right? If this seller bought this property in the last several years or refinanced it, let's say in the last several years, they might have a loan at 3% for 27 more years of a 30-year fixed amortization schedule. That's a really, really good loan. And that means that in this next chapter, sellers may have both the ability and the desire to sell their properties in a way that includes their excellent current loans. Their excellent current loan might be one of the best things that a seller has going for them. In other words, this means sellers may be more willing to sell their properties via a creative deal structure. So let's put all this together. The previous chapter meant that sellers had certain motivations for seller financing. The new and current chapter ahead has a different set of reasons for seller financing. Okay, all right, but let's just hold on for a second. You might ask, well, yeah, but the previous chapter is in the past, it's history. Are the previous chapter's reasons for wanting to do seller financing, are they still relevant? And the answer is yeah. Oh, absolutely. They are still relevant. Let's take a look at them again. Are there still people today and in the chapter ahead who will have a capital gains tax bill that they won't be really excited about receiving if they sell their property? Yeah, absolutely. There are those people. Are there people who will be at a stage of life where they say, you know, I want to sell this property, but the truth is I just don't want to trade it for another responsibility. I want to do something different with my time, energy, focus, and my life? Yes, absolutely. Those people still exist today. Are there people who, when they sell their piece of property, would like to continue to have an income stream from that piece of property instead of getting a big chunk of money that they have to go find a place to put, find a new investment to put it into? Are there people in that situation? Oh, yeah, absolutely. So here is what it all means. It means that sellers today now have two sets of reasons for why selling via seller financing may be their best option, because it's the best path for their own financial interests. That was true even in the previous market cycle. And it helps them sell their properties more easily today, which wasn't necessarily true in the previous cycle, but is true now. Both of these things, it's almost like there's now double the reasons why seller financing can make great sense to a seller. And to me, that makes this next chapter we are entering and about to embark into the perfect storm for thoughtful seller financing. So let me talk to you now about why not just anybody will thrive in this scenario, but specifically us thoughtful real estate entrepreneurs will prevail in this perfect storm of a market coming up. Let's go back to the word that we started with, one of the words, thoughtful. And we decided and we agreed that thoughtful means we've negotiated sensitively and we've negotiated strategically. So here's why us trees, thoughtful real estate entrepreneurs, here's why trees will prevail. And it really comes down to kind of two things: empathy and ethics. Now you might be thinking, well, that sounds pretty touchy-feely. And yeah, in part it is touchy-feely. That's sort of who we are as a community in general, but it is also very, very practical as well. So when we talk about empathy, what we're really talking about is deal structuring. You can't do your best possible job structuring a deal in a way that works for everybody unless you empathetically understand the seller and what it's like to be in their shoes and what it would be like to look at your proposal, which means that when you have more empathy, you have a much greater ability to get your proposals accepted, the proposals that reflect the deal that you have just structured, much better than somebody who doesn't have the empathy for that seller. Ethically, there are things that can go wrong for certain people who are not structuring their deals with care, not treating the seller with care, aren't aware of where some of the red flags are. So being ethical, which is a hallmark of the thoughtful real estate entrepreneur way of life and business, prevents problems, and it sets us apart from other buyers that these sellers might find themselves talking to. It gives them a completely different experience. So if you had to just sort of put this in a word, we trees are going to prevail because we have a focus on relationship. Because I hate to have to bring it up, but let's just be honest here. While those of us watching this training right now in this community of thoughtful real estate entrepreneurs, while we see this next chapter as an incredible opportunity to grow our portfolios thoughtfully and relationally by creating true win-win negotiations, there are other people who see something totally different. And what do they see? They see blood in the water. They're looking at the seller world these days and they're seeing people who are increasingly desperate. People who have really good underlying loans on those properties but are getting increasingly desperate. And what they're seeing and what they're sensing, what they're tasting is an opportunity to exploit the difficult situations of those sellers. And that can manifest itself in the form of those people, those non-thoughtful real estate entrepreneurs, making lots and lots of, quote, creative financing offers to buy those properties by taking over that existing debt. But I want to step back for a quick moment. As you might remember, in the Seller Financing 101 video training, I explained that there are kind of two categories of seller financing, and we could define these two categories based on whether there is existing debt on the property that the seller is selling and how that gets handled. So if there is existing debt on the property, it can either be handled one of two ways. Either that existing debt is included in the deal structure moving forward as the seller sells the property, or the existing debt is not included in the deal structure for the property as it's being sold by the seller. So if the intent is to include the existing debt that the seller has on the property in the deal structure, that's when these tools become relevant. Buying the property subject to the existing financing is a way of keeping that existing debt in place. Wrapping the existing debt with an all-inclusive trust deed, that's a different way of including the existing debt in the deal structure. Lease option, yet another way of including the existing debt in the deal structure. Land contract, similarly includes the existing debt. Assuming the loan is all about including the existing debt and simply taking it over and putting it in the buyer's name now from the seller's name. But when the existing debt is not going to be included, or perhaps there wasn't existing debt to include anyway, that's where promissory notes and trust deeds, this is installment sales, that's where these come in. And I told you that while we don't want to get caught up in semantics, I told you that I think creative finance and seller finance are different. And I told you that I see this category over here on the left, what I would consider creative finance, and on the right, seller finance. Now, the truth is, both creative financing and seller financing can, should, and will play a role in this upcoming chapter for us as buyers and entrepreneurial buyers. I personally will always be more interested in getting great seller financing than getting great creative financing. Now, a moment ago, I said that there are a whole group of investors these days who will sense blood in the water. They will see that sellers are increasingly motivated, increasingly maybe in some cases desperate, and that those sellers, while being motivated and desperate, have good underlying loans on the properties that they want to sell, and that these people, maybe these bad actors, will see this as an opportunity to exploit a seller's difficult situation by making lots of kind of, quote, creative financing offers to buy those properties by taking over that existing debt. So I realize that this begs an important question that I think we have to tackle head on. Are creative financing offers that include the seller's existing debt bad? Are creative financing offers inherently unthoughtful? And the answer is no. No, not at all. The tools of creative finance are just tools. There's nothing good or bad about a tool. I mean, when you look at a hammer, there's nothing good or bad inherently about a hammer. A hammer is just a hammer. But what we do with that tool can either be good or bad. It's more about how we use it. If you use a hammer to hit somebody, you've used it badly. If you use it to build a garage, you've used it well. There's nothing good or bad about a tool. It's much more about how we use it. And so here is the point. There are really two truths. The first truth is that these creative finance tools need to be used with great care for the sake of both parties, and especially the seller. Just stop and think about that for a moment. If you are going to be buying a property in a way that includes the seller's existing debt and may even keep the seller's existing debt in their name while you own the property or control the property, that needs to be navigated with great care for the sake of everybody's protection, but especially the seller. And the second truth is that through a lot of savvy marketing over the past few years, some of these creative finance tools have attracted a bit of a get rich quick and easy in real estate sort of a vibe. And personally, when I think of investors who have a get rich quick mentality, and I picture them wielding tools that really need and deserve to be used with great care, it's easy for me to imagine that bad things could happen and sellers could incur some harm. And therein lies, of course, the opportunity for us as thoughtful real estate entrepreneurs, because we will prevail through empathy and through ethics. We will win by having empathy, focusing on relationships, asking good questions and actually listening to the seller's answers to those questions. We will win by being top-notch pros at actually understanding sophisticated deal structure, while also never using our ability to structure deals to make proposals that are not truly in the best interest of that seller. We will win by setting ourselves apart from those investors who see blood in the water and are looking to exploit it. So here is the bottom line. Thoughtful real estate entrepreneurs will wield the tools with the great care that's needed, and that is going to go a long ways towards helping us all be as successful as possible in this next chapter. So how do we capture this unique opportunity? Because simply put, now there are more sellers whose ears are more open than probably they have been in a long time to hearing your proposals. So I think there's three keys that I want to talk to you about. The first one is we need to talk to plenty of the right kind of sellers if we want to capture this opportunity. Secondly, we need to lead those negotiations correctly. And thirdly, we need to structure a win-win proposal that has the highest likelihood of being accepted. So let's break it down and talk about each of these three individually. Key number one, talking to plenty of the right sellers. It's important for us to acknowledge that the best seller financing will always come from sellers who actually want to do seller financing, not just those who are willing to do it, right? And as there are more sellers who would be willing to have their ears open now, not all of them are people who want to do it, but they're more open to it than they used to be. But there's a big difference between someone who was willing to do it and someone who actually wants to do it. So we need to remember that we'll always be better off if we can find and connect with the sellers who want to do it, not just those who are willing to do it. And then secondly, the best seller financing, it's important to note, is always best negotiated in person directly with the seller, not through agents. If there are agents involved, as long as you can talk directly with the seller, that's what's most important. But this isn't something where you play the game of telephone and expect to get the best negotiation possible. You need to be able to see and talk to the other person and work out the best deal, the best terms directly with them. Hear everything they say directly from their own mouths. The first thing we have to do is we have to understand what makes a good candidate for seller financing. So you might remember from a few minutes ago how we discussed that sellers now actually have two sets of reasons for why selling their property via seller financing might be their best option. Because A, it's the best path for their own financial interests. That's the one that's been true all along. And secondly, because it actually helps them sell their properties more easily today than they might be able to sell otherwise. Now, here's the thing. The second group of people, these folks are great, but they're also really kind of obvious. And this is who all like the normal real estate investors will be looking for, right? They're going to be running their reports of properties with high day on market numbers. And they're going to be looking for people who are dropping the price and stuff like that. And they're saying, oh, there's the blood in the water. They must be desperate. Let me go make a seller financing offer. On the other hand, the people at the top, those for whom seller financing is just the best financial plan for them, there's going to be less competition here. There was a lot less competition in the last chapter. There will continue to be less competition here. Why? Well, because frankly, it takes a higher level of sophistication of a buyer to understand this person and understand their motivations. And as thoughtful real estate entrepreneurs, we have a major edge in terms of buyer sophistication. So who is it we are looking for sellers? We're looking for sellers who want those couple main things that I described before, which is they want to sell their property without having a big, nasty capital gains tax bill, and also not needing to do a 1031 exchange to defer that tax bill. And secondly, we're looking for people who would like to have continued income derived from that property or from their investment in that property, but without needing to go find a new investment. And when we can find those two things, we are talking to the right people. The second key is we have to lead the negotiation correctly. What does that mean? Well, it means that we can't rush the negotiation. The number one mistake I see investors make as they try to buy properties with seller financing is bringing up seller financing too soon. It makes it so incredibly obvious that the only reason they're even talking to the seller is because they want to buy with seller financing. But if we can slow down and we can have the conversation in a way such that the seller will ultimately give us clues that tell us that seller financing would actually be a good fit for them, we'll be much better off creating a proposal that works for them that they will say yes to. To lead the negotiation correctly, we have to focus on relationship, and doing that helps us slow down a bit and helps us not talk about the financing that we want to have too soon in the conversation. One of the absolute key principles that I operate by and I teach all of my coaching clients is that we must solve the person before we can solve the deal. Solving the person means truly understanding the seller, understanding their perspectives, their attitudes, their desires, their needs, really understanding our audience and knowing who we're talking to, knowing who we're working with. We need to understand what they're really trying to accomplish with the sale of their property. I like to say that nobody wants money. Money is paper and green ink. What they want is what the money will give them. The money might give them a boat. The money might give them peace of mind. The money might give them the ability to take the proceeds and pay off their primary residence so that they can relax with and not feel like there's a risk of them losing their primary residence. Nobody wants green ink and paper. They want what that green ink and paper will do for them, and we must understand what that is for each individual person because it's different for every single person. And lastly, key number 3 is we need to structure the proposal for a win-win outcome. Our key principle here is that we can only solve the deal and come up with that structure once we have solved the person. Because if we don't first solve the person, we're going to be completely flying blind in our deal structuring. All we're going to be doing is thinking about what we want in the deal, which is not going to lead to a win-win, which is not going to lead to something somebody else is likely to say yes to. We have to be thinking of them and understanding what they want in order to put together a deal structure that's actually going to appeal to them and get them to say yes to it. So we have to solve the person so that we're not flying blind. And when we're flying blind, the other danger is that we're making assumptions about the seller and what they would want, some of which may hurt us. If we come into a deal structuring exercise with an assumption that this seller wants the largest possible down payment, and we propose a 25% down payment because that's what we assume that they would want, we might end up shooting ourselves in the foot. If this is a capital gains driven seller who doesn't need or want the money, they might want the lowest possible down payment because that down payment is going to trigger some of their capital gains. They might not want to receive any more down than they absolutely have to. So we don't want to make assumptions because by doing that, we might accidentally end up hurting ourselves. Instead, we need to solve the person first. Solving the deal is all about coming up with a deal structure that works for us and also gives the seller what they want and what they need. Solving the person is very qualitative in nature, but solving the deal is much more quantitative in nature. This is where we're going to do the math. This is where we're going to get the deal calculators out and our analysis spreadsheets, and we're going to figure out what combination of terms is going to work for us and will work for the seller. Ultimately, this is going to lead into exactly what we're going to propose to the seller. What is it that they are likely to say yes to that we would also be happy with? We're coming up with deciding what our price will be, what our down payment will be, what the interest rate will be, the type of payment, the loan term, etc. Those are all the things that we are doing as we work on structuring the proposal for a win-win. I want to take just a moment to tell you how we can help you capture this unique window of opportunity with this perfect storm for thoughtful seller financing. The truth is that this whole process is both an art and a science at every single step. It's an art and a science of finding, of negotiating, and securing off-market deals with seller financing. There's an art and a science, but the good news is all of it is completely learnable. It absolutely is. And the Deals Workshop is our coaching and training program and community that gives you the exact step-by-step training and support that you need to put off-market seller financing deals in contract. Let me tell you just about the framework for how we go about doing that. The core essence of the Deals framework is 6 things. First, we identify. Secondly, we reach out. Third, we build rapport. Fourth, we solve the person. Fifth, we solve the deal. And sixth, we propose. Let's take a look at each of these a little bit closer. Identify. We have to decide who is going to be a good candidate for seller financing, and then we have to get a list of those people so that we can market to them. Once we have done that, now we're ready to reach out to them. But we have to decide first what is going to be the best way of reaching out to them that's likely to get a response and to establish the right kind of relationship that we need to have to create a seller financing conversation. So that means we're going to be talking about choosing the message. What do we want to say to them? How do we want to position ourselves? When we send a marketing piece, how should it be packaged and formatted so that it's going to be as successful for us, make our phones ring as much as possible? And then we need to get those communications, which in our case are letters, out the door. Then we need to build rapport, because you know what's going to happen next? Your phone's going to be ringing. When the phone rings, what do we do? What do we say? How do we establish the relationship? How do we transition ourselves to getting face-to-face with the seller and begin the process of solving the person, which is our third step? We need to solve the person, as I just mentioned to you a few minutes ago. We need to go to the seller meetings. We need to know how to conduct those seller meetings, those conversations, and so that we can ultimately understand this person, their needs, their perspectives, their attitudes on their property, on themselves, on the market, on the world. We need to be able to do all of those things to be successful in our negotiation. We need to be able to identify their one big thing, which is the single biggest factor that will determine whether they move forward or not. We need to understand that, and we need to listen for the seller financing clues that open the door for us to make a proposal later about seller financing. Then and only then can we solve the deal. Solving the deal is our next step, and it's all about analyzing the deal. Like I mentioned a moment ago, it's about doing the math, determining the deal structure that will give the seller what they need and also works for you as the buyer. It's deciding what seller financing terms actually make sense for you and for them and for the deal itself, and then getting ready to make a thoughtful proposal to the seller. And that brings us to the final step, which is making that proposal. We need to meet with the seller. We need to deliver the proposal using the framework that we talked about in the Seller Financing 101 videos. We need to get the seller's feedback, and we need to revise the proposal as needed until you have agreement. And we need to write the deal then that we've agreed to verbally up in purchase agreement, paperwork, formats, and get this thing into escrow in a proper manner. All of these steps are very learnable, and this is exactly what we do in the Deals Workshop, is teach you each of these steps, hold your hand, walk you through them in a training setting and in a community setting and in a coaching setting, so that you too then can put off-market seller financing deals in contract. So if you like the idea of having detailed, hands-on, step-by-step guidance and training on all these steps, here's all you need to do. Just go to thedealsworkshop.com. You'll see a big red button that says apply to join deals. Simply click on that button, and you will then go through a series of brief pages that tell you more about the workshop, how it works, who it's a good fit for, who it's not a good fit for. It will help you decide if it feels like a fit for you. And it will basically decide also if you feel like a fit for the deals workshop. And at the end of those couple pages, there'll be an opportunity for you to fill out a very short form with your contact information and submit your application. There's no cost or obligation to do that. So go to thedealsworkshop.com and check it out. I'm excited for you. Heck, I'm excited for me. I'm excited for everybody who is part of this community, because I truly believe that we are entering right now a period that is the perfect storm for thoughtful seller financing. And I know that you can make tremendous headway in your wealth building efforts through rental real estate by taking advantage thoughtfully of this opportunity to buy more properties with seller financing.